definitely a risk that they highlight in their prospectus. SEA wants to win in all of these three verticals, and one of the ways to actually get as much market share and can't be shy in your spending if you want to secure that turf.
Hello, I'm Noelle Lim on ASEAN Speaks. The Fed has indicated it will pursue a more aggressive monetary policy tightening, which can have repercussions on the valuation of technology stocks. How would this in turn affect tech stocks listed in Singapore? Hardware manufacturers AEM and UMS have rallied to a new high about 2 months ago. Do they still have legs, and what is the risk of a semiconductor glut? I speak to research analyst Lai Gene Lih for his perspective. We also discuss SEA Ltd, the owner of Shopee. Gene, how do you expect technology stocks in Singapore will fare this year?
Okay, so overall, in our Singapore tech coverage, we cover a bunch of tech hardware stocks as well as one internet stock. So to the narrative that we might be seeing a more hawkish monetary policy environment, and to that, and as a result of that, we might see a rotation from richly valued growth stocks to more value style old economy stocks. We think this narrative would apply more to SEA Limited simply because SEA is still loss-making. But beyond the kind of normal market volatility, we really don't see this narrative applying to the rest of our tech hardware coverage. So all in all, we think that for our tech hardware coverage for the stocks that have good growth catalysts and reasonable valuations, we think that they should continue to do pretty well this year. In particular, for some of our tech hardware coverage, their valuations are rather undemanding, trading around like low teens PE on FY22. And some of them, especially in the upstream side of things, being the companies that are involved in the semicon equipment supply chain, some of them actually have pretty good growth prospects this year.
Why are their valuations undemanding?
Valuations undemanding, I would say partially there's been a little bit of a pullback in terms of share price in the past few weeks or so. That's probably number one. Number two was also, I think, depending on some of the one or two of the companies, we may have, in that sense, increased our estimates on FY22 over the past results season. Singapore tech hardware valuations tend to be either in line or maybe a slight discount to global. And so I think for the most part, and really as a generalization, mid-teens kind of valuation, or maybe just slightly above mid-teens, tend to be what we associate as cycle peak valuations, which is really quite unlike Malaysian valuations, which can be quite a fair bit higher.
I'm trying to understand the behavior of Singapore investors. It seems to me it's not difficult to sell a tech story, but why is there a gap and the market is not quickly pricing in catalysts in Singapore?
In particular, for some of these tech stocks that we look at, and I would narrow this down to AEM and UMS, they have done pretty well over the past few months. And because the market sentiment is not very strong right now, so I wouldn't rule out that there are some investors or even traders, taking some money off the table. And then perhaps when they see that, based on how they perceive it, that the events or rather things have troughed, then maybe they might start to enter again, and then probably that is what leads to the next wave.
You're positive on the hardware makers like UMS and AEM. What are your assumptions supporting their earnings growth?
The backdrop for semiconductor equipment spending continues to be very favorable. So in the front end, we expect TSMC's 30% growth in capex, as well as Intel's 40% growth in capex in 2022. We really translate quite well to the companies that we look at, like UMS and Frencken. And on the other hand, we also expect AM to be a beneficiary of new generation equipment for its key customer Intel in 2022, and also in future years as well. And we also see AM as a beneficiary of Intel's projected 10 billion spend in Penang. And I think one of the drivers that should kick in 2022 in a more material fashion than in previous years would be contributions from new customers as well. So collectively, I think these would be what's supporting the growth of some of these companies that we're looking at that are exposed into the semicon equipment side of things.
I'm reading headlines that there may be a semiconductor glut in 2023 or 2024. What are your industry sources telling you of a likelihood of a glut? And would chip shortages start to ease in second half of this year?
rather broad consensus, if you could put it that way, is that a lot of people expect chip shortages to last at least into the second half of 2022. So as such, I don't think that there could be or there should be a glut, a semiconductor glut this year. Whereas, could there be a glut coming in 2023 or 2024? I think that's a possibility, although we would want to sort of monitor this event a little more closely. And I think the whole idea of why 2023 is sort of the time frame we start thinking about a glut, because I think there will be new capacity coming on stream. And there's also a concern right now, which I believe not a lot of people are, or hardly anybody is able to know with any degree of accuracy, which is that how much of double ordering there is at the end of the cycle if we have too much inventories and then we've got too much capacity as well. That's the recipe for the glut. Some of these unknown factors is probably a little bit hard to quantify at which juncture with any degree of accuracy, when the glut will come. But I think 2023, 2024, there is that possibility.
If there is excess capacity in 2023, how will this affect UMS and AEM?
So I would maybe start up with AEM first. Sorry, I will start with UMS first. If there is a glut in 2023, then it might be the case that capex, semiconductor capex, might be dialed back, and that would not translate very favorably for UMS's key customer. In this case, it's Applied Materials. So in which case, then that's how it's going to flow to UMS. It may create a scenario where 2023 earnings would be less than 2022. One of the mitigating factors we are hoping that could take place is that if there's a new customer, so UMS is expected to complete their new plant in Penang in the third quarter of 2022. Right now, we think that this plant is largely catering for a new customer, and then we hope that if the new customer comes in on time, then perhaps that could moderate cyclicality effects. On the part of Frencken, the same logic applies. If there is a peak in semiconductor capex at some point, then it just results in a semicon cyclicality. So this is where, in that sense, Frencken has some form of advantage over UMS, because Frencken is a lot more diversified. Then hopefully some of the other segments can take over that growth baton from Frencken's own semicon side of things. But since we're discussing about Frencken, I'd like to just also point out that what we've been hearing from the company is that based on their current visibility, they expect the outlook for semicon equipment to be rather strong both in 2022 and in 2023. And now back to AEM, because AEM's revenues are so closely tied to Intel's spending, specifically in terms of tests. So we still probably have to see what is Intel's own plans, spending plans in 2023. And in that sense, maybe AEM's earnings cycle may not be tied as closely as overall global sort of semicon capex, but more idiosyncratic towards what Intel is planning for their own test budgets.
What do we know about Intel's plans for AEM?
For one, Intel seems to be really focusing a lot on heterogeneous packaging. And one of the things that AEM is really good at is in the area of system level test. And the whole idea here is that with heterogeneous packaging, the requirements for system level tests really does increase. And with Intel's new chips, being Sapphire Rapids and Alder Lake, these are Intel's first mass-produced heterogeneous package chips. Heterogeneous packaging, or I'll just maybe call it advanced packaging, used to be something that was probably a little bit more low volume at Intel. Now they are making it a core offering, or bringing that technology to their core products. So we think that AEM is going to benefit from that. The next thing also is that we see some of this sort of being translated into their spending plans. So the 10 billion spent in Penang is largely to increase assembly and test capabilities. And so I would think that this is to cater towards building their capacity and capability in terms of heterogeneous packaging on the assembly front, and then also to also beef up the capabilities and the capacity post-assembly and onto the test side of things as well. So that's probably how I will read things. Also, that Intel is also relying on TSMC for some of the chiplets going forward, and then so you think that TSMC has their own chiplet technology. Intel has their own chiplet technology. So when you put these things together, I think you probably need to put in a higher degree of tests just to make sure that the product comes up pretty reliable. It should be on balance positive towards AM.
Why are you less positive on the contract manufacturers, Valutronics and Venture?
I think it's largely simply because we are probably in a market climate where these guys still face some degree of earnings uncertainty with regards to still lingering chip shortage. If they can't get the chips that are needed to complete the entire product, so it doesn't even matter if it's 90% complete. If you can't get the balance 10% of the required components, you can't ship things out the door. And if you can't ship things out the door, you can't book all these things into revenue and hence earnings.
I'd like to get your views about China's dual strategy of self-sufficiency. Longer term, how does this affect Singapore tech companies under your coverage?
A lot of companies that we cover are manufacturing companies, and given a long enough time frame, they will try and respond and adapt to these changes. For example, Valutronics, they had a lot of their production footprint in China, and now having a large part of their allocation for the US geography being sort of lost as a result of the US-China trade war, they are building a plant in Vietnam to rebuild that revenue base. And so going forward, where we do see or how we do see them grow would be, Vietnam will be purposed for the international markets, whereas their China capacity will be to cater for the domestic demand. So that's how they are adapting. And the reason why I specify that the manufacturers that we cover, it's very likely that they can adapt. It's also because these guys are really prioritize their customers. And in that regard, a lot of their customers are also the sector leaders, the blue chip companies, and the product leaders in their fields. So in that regard, they probably are constantly sussing out what's going on with the world and whether they have to adapt. And then the suppliers would probably want to try and adapt with these customers as well. So when we talk about the long run, then I would assume that factors enough time for everybody to adapt alongside.
Why Vietnam and not Malaysia?
I think so. In the case of Valutronics, it's largely due to logistics because their factories happen to already be in South China. So Vietnam is relatively, especially the north of Vietnam, is relatively close. It depends on how each of the company or their customers decide to shift the supply chain. Some are actually going towards Malaysia, some are going towards Indonesia, some are going towards Thailand. So it really becomes rather company specific, or rather to the idiosyncratic needs of the company and the customers.
I would like to talk about SEA Ltd. It's a apparent favorite because it's a Southeast Asian digital champion in high growth domains like gaming, e-commerce, and financial services. And the fact that and also what makes it interesting is that China's crackdown does not affect them because they are primarily in Southeast Asia. However, when do you expect they will start making money as a group?
We are expecting at least in the next 2 to 3 years that they should be able to start making or should start being able to turn a profit. The investments that they put in is largely to grow the domains that they want to grow. For instance, like growing Shopee as well as growing C-Money, the digital finance side. And a lot of investments that they have to put in happen to surface up on the P&L. So that's the reason why, in that sense, they are still incurring losses. And in that vein and in that fashion, alongside the street, have been notorious in underestimating the amount of investments needed by SEA to grow the kind of markets and businesses that they want to grow. But in the prospectus, SEA has actually very clearly stated that they might actually never turn a profit. And also if you watch the way they behave, they are not the type that, just because you want to turn a profit, you switch off your spending, and sacrifice future growth. But they tend to be the otherwise. They tend to spend all they need in order to secure a foothold.
Investors are bullish on SEA despite the prospect of not making money. Are we getting ahead of ourselves?
It is definitely a risk that they highlight in their prospectus. And we do see a risk that, this could be delayed. But ultimately, we do see them wanting to turn a profit. On the gaming side of things, it's actually a very cash flow generative side of the business, and a lot of that proceeds are being used to fund the growth in Shopee as well as in digital finance. And so the idea is that because SEA wants to win in all of these three verticals, and one of the ways to actually get as much market share and basically to claim your turf is by spending. So you and maybe that, or rather the way we see it is that they're taking a stance that you can't be shy in your spending if you want to secure that turf. And once you secure that turf, what they want to try and do probably is to try and make the customers more sticky. And then once they see the kind of retention that they want, and the kind of ecosystem built, that's probably when they might start to see it more sustainable to focus on the profitability metric. But until then, probably if you want to try and turn a profit, you might actually cede share, or you might open yourself to the vulnerability of someone with a much bigger spending appetite overtaking your position and eating into your turf. So I think that's probably what SEA is thinking about.
Thank you for speaking to me, Lai Gene Lih, analyst at the Maybank research team in Singapore. To get the reports on the stocks mentioned, speak to your trading rep and check out market insights on the Maybank Trade app. I'm Noelle Lim on ASEAN Speaks for Maybank IPG.